Now let's talk to Kartik. So, good morning.
Hi, James. Morning.
We're going to start off with you as usual. Just tell us a little bit about Artemis Alpha and what it's trying to achieve, please.
Okay, right. Yeah, good morning. So Artemis Alpha is a listed investment trust. Artemis has been running it since June 2003. I've been the lead manager on it since mid 2018. The portfolio has gone through sort of various evolutions. It used to be largely focused on small and mid-cap UK stocks, particularly oil and gas and asset management. It had a very high weightings there. Today, it is quite a different portfolio. 80% of it is in large cap or liquid stocks. And it is run with a different philosophy to what it has done historically. Over the long term, returns have been pretty good. I took over after a period of underperformance, and I'd say returns have been pretty volatile since I took it over. So 2 very strong years, 2 poor years. Last year, the portfolio returned 17%, which was ahead of the FTSE All-Share Index, about 8%. And really, so in terms of what it does, why it's kind of different. So firstly, Artemis current and ex-employees own about 25% of the capital, 20 to 25%. As you could, well, on a previous slide, you can see I'm a reasonable, I use it as my primary savings vehicle. And so I think we're slightly different from other investment trusts in that this is a primary savings vehicle for a lot of the employees of Artemis, and yet we have all the scale benefits that are derived from our larger infrastructure and the money that we run. So today, the trust has about 30 to 35 holdings with an average weighting of 3.5%. Another thing that differentiates it from some of the other UK all companies investment trusts is about 30% of the portfolio is invested overseas. I'll touch on process in a second, but effectively it's long-term value investing, and clearly that's quite a broad church. But I'll tell you about how I think about it. But I think it's quite important to emphasize that it's a very much bottom-up driven investment process, and we are concentrated. Particularly the top half of the portfolio is quite concentrated in areas where we have conviction. And if you look at the portfolio today, the sort of two characteristics that I think come out are we're focused in sort of two areas is areas where we see a clear undervaluation of risk-adjusted returns in capital cycle businesses, particularly which are UK facing. So about 50% of the portfolio is exposed to the FTSE 250. But then we also have exposure to what I call durable franchises, which where we also think the risk-adjusted returns are quite compelling, but they're largely because they are low-risk companies for the returns that they have on offer. And perhaps the last thing to mention about the structure of the investment trust is we do use gearing. So currently gearing is about 13%. It's been about that way since the pandemic. So we were ungeared going into the pandemic. We increased our gearing to 10-12% then. And that's the structure of the portfolio today. So James, if it makes sense, I'll run through kind of how it's run, what's in it, maybe one example, run through the logic and thinking behind our largest holding, and then maybe stop there if that makes sense. Is that a good plan?
Perfect.
Yeah, cool. Okay, so just investment philosophy, because I think it's very important to understand, because actually most investment processes, I think, if they run well, are quite similar, is it's more about what you put an emphasis on. So just to point out, I mean, in my book, if you're investing in equities, you need to be long term because you are buying perpetuities, where the majority of its value is derived from effectively what it will generate over the long term. In my opinion, quality and value are often thought to be sort of enemies or different sides of the spectrum, but the reality is that quality is a spectrum. And valuations matter. So effectively, you can buy the best business in the world, which will have very good long-term returns, but the valuation will likely be a headwind or tailwind in terms of how those business returns translate into stock returns for you. And that's why, and this sort of philosophy around being what I would call quite flexible about quality and valuations explains the sort of reasonably eclectic mix through a value or growth lens that you see in the portfolio today. I always operate with the mentality to treat others' capital like you would your own. In the case of this trust, you can see quite clearly that a reasonable amount of the capital is our own. But I think that's important. So we wouldn't do something that we wouldn't do if it was just our capital. Diversification, I hope you'll see this in the way the portfolio is constructed, but in my opinion, it's the only free lunch for investors. So pretty staunch believer that Harry Markowitz's principles are around diversification and correlations and what that can do to a portfolio's overall return are important considerations when you're assembling a portfolio. And then a couple of other things which you'll see reflected in the sizing is we think it's really important to know what you own. The greatest risk and opportunity is in the portfolio you have, not what you don't have. And you need to be able to really have a good understanding of that to withstand volatility and in certain circumstances take advantage of it. I often like to say that we like to look and buy a stock like we would consider a house. And then running your winners. So in my judgment, to generate significant alpha over the long term, it's really quite an important thing to do. It's something that an index does indiscriminately. And that I think that's one of the reasons why indices have performed well relative to the average active manager, is because running your winners in itself can be quite hard to do at times. And clearly it's not always the right case if you can come up with something better to do. And then if you invest in the trust and you read our quarterlies, etc., I think you'd see that I think the way you communicate and help calibrate your investors' experience of risk throughout their investment is of paramount importance. And I always like to say that our clients should never be surprised with what we do if we communicate properly. So coming to the next slide. So I've gone through sort of various evolutions in my career of investing about how you think about returns, and the one which I like the most, and I think it's important to understand how we think about individual stock returns, is we try to come up with an assessment of what the IRR is on a ideally 5-year holding time horizon. Why does that matter? Is because effectively I see every stock we hold as a sort of mini savings account with a return, a yield, the IRR, which is not advertised, but which is very important to try and forecast, so you can make an accurate comparison about both the absolute and relative returns on offer compared to the risk characteristics that the stock you're in and the stock you could be in offer. And how do we do that? I can talk through some examples of this, but it comes down to making a judgment about the earnings potential of the business. In doing so, it's very important to try and understand the capital intensity or the return on invested capital of that. So, if you buy Unilever, who I saw this morning, they generate a high return on invested capital, and it means that you can get back money in a dividend as they grow, or in their case, not grown very much in the last decade. Whereas, if we're investing in EasyJet like we are, we've got to be very mindful that the cash, whilst they're growing, isn't really coming back to us because it's being reinvested in new planes to fund that growth. And then on the right-hand side, something we do quite explicitly is make a judgment on the multiple that we think the business is worth. And so, again, if based on its characteristics, its risk profile, and its return on invested capital, in my opinion, coming back to this point about quality as a spectrum, the justified PE multiple of all businesses is not equivalent. And sometimes you're able to buy businesses where the earnings stream is very interesting, but also there is a potential to benefit from a re-rating of the shares. And I'll run through the example of Frasers Group, which is our largest holding, where in my assessment over the next 5 years, the potential for the stock to re-rate has the benefit to improve your compounding of stock returns, even though evidently that has no bearing on the company's ability to compound its cash or earnings. So I'd like to say that, why IRR, why not intrinsic values, is because I think it makes you focus on being prescriptive about how you think about an investment and what needs to or not need to happen for it to work. And also because time is money. So a lot of value investors can have long shot bias, which is, risk is always asymmetric to the upside when you can only lose 100% downside. And not being specific enough is a mistake we've made in the past. And we've sort of entered into investments where you could effectively have got into a low risk alternative where the returns were more visible. The last thing I maybe say on the slide is, if you look at a UK bank today, evidently a large proportion, you can decompose an IRR. So you can say, if I hold NatWest and its multiple doesn't change, what am I getting just from the compounding of its earnings? Which, I'll sort of half make up this number, which might be something in the order of 15, 16, 17%. And then you can also go one step further and say, that, call it today, about 8% of that is coming in dividends. And you can compare that to another stock, which let's say you think is going to make 15%, and really look at it and say, well, how much of that is in the growth of the earnings? How much of that am I getting back in dividends? And what is it in the multiple? To really try and be prescriptive about the risks in you achieving the outcome that you want. So just on the next slide, I think an important point is that, okay, so how are you going to generate alpha? In my opinion, alpha comes down to sort of a number of different things, but I like to distill it into these 3 points, which is fundamentally you need to come up with a differentiated view of the risk or return on the investment. And I think it's George Soros the once said that, to be a differentiated investor, you have to have a differentiated view of risk or return. And that's really the hard work of trying to look at something and say, a year and a half ago, were the risks that were in front of Meta existential or not? And coming to a judgment on that or the ability for, say, in the market today, car litigation to meaningfully detract from your returns in UK banks, in Lloyd's case, as an example. So the left-hand bucket is really, I think, the prescriptive, detailed work that you need to do to build insights into your judgment of risk and return. In the middle, minimizing behavioral biases is that sort of Richard Oldfield's simple but not easy. Is in fund management, you effectively have to be, to a degree, quite robotic and unhuman, and almost sort of defy what your sort of instinct would tell you. It's quite important that you build the right principles in your investment process in order to do that. And then on the right-hand side, in terms of portfolio construction, I think this is something that, there's less written about it. So there's a lot written about it on how to buy a stock, how to value a stock, but there's a lot less written and, in my opinion, thought about how do you put that together in a portfolio that can help you take advantage of opportunities in the market, which is why I reference Harry Markowitz. So coming on to the next slide, this is just a snapshot of the portfolio, given the time constraints that we have, because I wanted to touch on some macro observations and Frasers. But if you look today, the portfolio's got roughly, and these are outcomes. It's not how we think about it. So we don't really think about these buckets. But if you want to bucket the portfolio, I think this is one way to do it, is about 50% of the portfolio is in capital cycle businesses. So this is effectively where we think there's industry change that's going on that is improving the returns to the industry, or where effectively the industry structure is very conducive to potential returns when individually that would not necessarily always be the case. So Frasers and retail, maybe I'll come on, but clearly what it's about there is the damage that online did to retail has led and is leading to a continued consolidation of the industry, which is a sort of Darwinian force that's making the stronger. UK house builders, which are very topical given this week's developments. Again, there it is about the returns that those in the industry are able to get against the which is largely around how difficult it is to operate in this industry because of the planning system, combined with what is a shortage of housing and a demographic need that means that demand is always compounding even when it's not met by supply. Airlines, I think, is a really fascinating one today because obviously, so low-cost carriers have been a very good part of airlines to invest in, but airlines as a whole has been a sort of dreadful long-term industry to invest in. If you look today, the setup for, I think, European airlines is, I'd risk to say, I think the best it's ever been, because of what the pandemic has done to the broader supply chain, because of capacity constraints, because of environmental considerations. That means it's really very hard to expand capacity in this industry when I'm sure anecdotally and from the data, you can see the demand for travel is a function of wealth, and that compounds over time. In the middle segment, I'll try and go a bit faster here. You can see we've got a range of businesses. I saw you were talking about Pershing Square. So we bought Universal Music Group in May at 18.50 a share. It's currently 28. The logic there was that it's a brilliant long-term franchise, and we thought the risks being factor around the AI's potential to disrupt music were overstated. And so this is often where we'll go overseas to find something which we think is more compelling than in the UK, because that's why and how we go overseas. But you can see across here we have what I would call platforms or exchanges. Hargreaves Lansdown's a stock we bought at the start of this year. Plus 500's a stock we've held since 2016. And it's effectively a volatility hedge where you get paid for, down to sort of what I would call a more commonly understood low risk businesses like Haleon, which is the spin-off for GSK, which we added to significantly after it was spun, to Vinci and Ina, which are two European listed stocks. I should probably mention I manage a European fund as well, which, Vinci owns effectively half the toll roads in France. Ina owns every airport in Spain. Those are assets where you could leave to your grandchildren and they'd still be there. It's immense duration. And the question just is more about what return you're giving them and, whether there's something like a regulatory risk that you need to think more carefully about. And in the top segment, we have a sort of, UK banks are, I would call, an idiosyncratic investment, because it's more there that we currently still think banking is a reasonable place to be invested. You can see UniCredit's gone up 3.5 times in a year and a half. European banks having a very good time. UK banks aren't, for reasons we could discuss. But effectively, we think the banking construct is still an attractive one to be in, and the cost of equity that's implied in NatWest and Lloyds should make for very attractive returns in the future. And then if you look on the right-hand side, so funerals, I should probably touch on that one, is we had a very large holding in Dignity. I used to sort of refer to it as having the potential to be a Geico holding for the fund because of its unique structure. So it owns crematoria, which is an infrastructure asset. It owns at-need funeral homes. So that's when someone passes away and you need a funeral immediately. And that's the business that's really been challenged by competition and capacity expansion. But it also owns this incredible business where it pre-sells funeral plans on average 10 years before people need them. It gets the capital 10 years up front. It can invest it in how it would like. And it's actually, unlike Geico, all hedged on its costs, because it needs to deliver you a funeral, for which it owns the funerals and the crematoria. And that's a business which we thought could compound really wonderfully. And it was bid for at the start of last year. We've switched approximately 2/3 of our holding into the investment trust that has 95% of its NAV in Dignity. Excuse me. I think maybe let me move on and skip some of these other comments, because I want to sort of speak for 5 minutes on the macro and then talk about a stock, because I think it'll hopefully bring to life the way we work and think. If you look on the macro, I guess there's a kind of point. It's kind of not if you invest in Artemis Alpha here, it's kind of more of a why can UK investments be more reasonable than they have been over the last 5 years? Is firstly, if you look at the FTSE 250 in particular, the total return since this is the start of 2020 has been really very poor, both in absolute terms and in real terms. And if you think about where this was in October, in October, FTSE 250 investors had, in real terms, lost, more than 1/3 of their money. That's a bear market, which I think everyone can feel, but is not that sort of violent, because it's been slow and it's happened over several years, and inflation is taking away more of your wealth than the nominal returns would suggest. So, UK investors have had it tough. And if you look on the next slide, I guess an observation I just want to make is that, I sleep with a copy of Daniel Kahneman's Thinking Fast and Slow on my bedside table. But coming to that point about minimizing behavioral biases, is that I think loss aversion can explain a lot of behavior in the UK right now. So Kahneman had this, it's a bit like, if products get cheaper in a supermarket, you buy more. If products get cheaper in a stock market, you get worried. And that comes to your sort of, it's because when stocks are going down, you're worried about why they're going down. Will they go down further? Usually when you're buying things down, you don't call the bottom, so you lose more money on your way down. But if you look at the loss aversion is something that all humans do. So New York taxi drivers, there was a study on this. When it rains, they earn more because there's more demand. They can charge higher fees. And when it's sunny, they earn less because it's sunny. There are better alternatives. You can walk in places. Counterintuitively, New York taxi drivers work harder when it's sunny than when it's raining. Why? Because they feel like they're losing money on a sunny day relative to a rainy day, even though the price of their leisure is much lower on a sunny day. So they should work harder in the rain and go on holiday when it's sunny. And if you think fund managers should do the same, is be very active in a bear market and sort of sit back in a bull market. But the reality is that your natural survival instincts tell you to do the opposite. So if you look on the next slide, and I'll just touch on this briefly because you can read it, is effectively, I think there are a lot of reasons, and some of these are totally credible. If you look at sort of, I think profitability, I think government intervention has reduced UK PLC profitability by more than some of these macro factors that people cared about would. So, I think that's a real issue. But if you look, I think there have been a number of perceptions about the UK which aren't so true, or which are changing. And so, one is that if you remember a year and a half ago, particularly when quasi-quoting blew up the bond market, is there was a sort of perception that the UK had an idiosyncratic inflation problem. It's now becoming pretty clear that actually, the developed market world experience of inflation is all pretty similar. There was this perception that the UK GDP's lagged peers. Actually, the UK is far outgrowing Germany. It's okay. It's not as good as America, but GDP growth is fine. UK politics are a mess. I mean, I guess that's probably the most true statement. But compare this to the setup today to 2019, when the election was a very binary outcome, and you had a conservative and Labour Party with very divergent views on how to govern the economy. Today, you've had the Conservatives move to the left, and you've had Labour move to the right. And Betfair would suggest that there's very little uncertainty about who will win the election. And then the last point is, confidence, animal spirits, both from consumers and corporates, has been impacted by inflation. So as that falls, I expect the environment to improve. So on the next slide, I like to think about equity returns in terms of equity risk premium. That is, how much are you being paid over an index-linked, inflation-linked, risk-free alternative for the uncertainty that comes for investing in equities? Because you can invest in the yellow pages, you can invest in serious minerals, you can make mistakes and think things offer good value when they actually don't. But if you look today, so one observation I'd make about the bond market is UK 10-year gilts, which are inflation linked, offer you almost no real return. So if I were to if my mother-in-law were to put her retirement savings in UK 10-year yields, she would take no risk, and she would also just guarantee that her wealth is neutral in real terms. If you compare that to the equity yield on inflation on equities, that's about 9% today. And so the spread that equities, which should be inflation linked, and they have often provided the best hedge against inflation historically. For any more evidence of that, please look at the Turkish market last year, is 9%. And if you look back to the 90s, when bond yields were what I would call above average and what a lot of people call normal, equity risk premium was much lower than it is today. Now, you could look at things like, say, the structure of the UK market. You've got 30% in banks, commodities, and oil on those risky segments, and they warrant a higher equity risk premium. I would agree with you, and I would say, yes, that's the case, but Lloyds Bank and NatWest offer an equity risk premium of an equity yield of close to 20%. So I guess I'm just making the observation here that I think the UK market statistically should offer good returns from here going forward. I thought I'd just say a word on AI on the next slide. Is Clay Christensen's written a lot on this, and I think it's quite a useful one because the internet just did so much damage to businesses. So think about Debenhams, which just died such a slow death, or the fact that M&S is only sort of turning around now. Is the internet was really hard to deal with because it effectively rewrote distribution channels in a way that benefited new entrants, and fantastic new entrants in the case of Amazon. What I just wanted to say is, my judgment sitting here today is that it seems much more likely that AI is a sustaining innovation rather than a disruptive innovation in the way that it is looked through in this lens. Um, and one of the best ways that I think about this is if you look at Microsoft. I mean, the company's worth more than Apple today. I think it probably offers still quite reasonable prospective returns, but Microsoft can't create so much value without its customers doing well. And its customers are enterprises, and the UK is a service economy, full of enterprise customers. And so I think the efficiency gains that AI is likely to bring is much more likely to be a positive for UK PLC than what the internet did. So if you look on the next slide, and we could talk about this in more detail, is something like financial services, where I've put a quote from the HSB CFO, COO below, is something that's actually really well suited to the adoption of AI. And it's quite likely that gets commoditized and those returns get competed away in the long term. But it probably benefits large incumbents, which I think is interesting and something that means that AI is more likely to be a risk than an opportunity. If you look at what I think might be at risk, I've put pharmaceuticals down there because of the potential changes in drug discovery. And we hold GSK, and we've had a call with the CTO of the head of R&D at GSK to discuss this point. But pharmaceuticals is something where maybe change there is negative. I don't think anyone really knows yet. But overwhelmingly, both for the market and particularly for our portfolio, I'd like to think that AI is somewhat of a net positive. Maybe I'll spend just the last 4 minutes running through. So we have about today 12% of NAV in Frasers Group. And I thought I'd just tell you how we think about the investment for 2 reasons. One, so you can understand this is the thought process that goes into all of our investments. But secondly, I know it's quite a controversial investment. It's clearly not the most popular stock, and we have a high weighting in it. So, I'm sure it could deter people from the trust, actually. So I'll run you through what I think about Frasers Group is. So a couple of things here. So Frasers Group, so Frasers core business is Sports Direct. Most people know what that is. Just to highlight, in the UK, that is a duopoly. So JD Sports operate in the athleisure segment. Frasers or Sports Direct operate in the sporting goods segment. And there are very few other shows in town if you want either football boots or Nike athleisure trainers. If you compare that to Sports Direct, we're just looking at buying the largest retailer in Germany, and its turnover is 300 million. Whereas if you think Frasers UK turnover is closer to 2 billion, it shows you that the UK is a consolidated market, and that's a favorable industry structure. And the reason it's consolidated is because of the power that the brands hold, which are primarily Nike and Adidas. Frasers have moved into luxury retail. I think this is an underfollowed story. They own the brand Flannels, which they bought from acquisition, and then they've expanded organically. They bought Matches Fashion Group, which was sold for, I think, approximately 600-700 million in 2018. They bought it for 50 million. They paid 30p on the pound of its debt. And effectively, what's happened here is department stores have left a void. Luxury's grown very quickly to distribute luxury goods in an experiential way in outside of London in the UK. Frasers are the leading player there with their flannels business, which has grown really quickly and has many of the strong characteristics that the group has. Just on own label, I think some people don't know this, but close to 40% of Sports Direct sales are own label. The company owns Slazenger, Dunlop, Caramore, Everlast. Everlast, it has an 80% market share in mixed martial arts globally. So the Everlast brand alone within this retailer, I think, is very valuable. It's got extremely low cost operations. So when they acquired House of Frasers, it had 500 people on Wigmore Street. They acquired Matches, it had 500 people in the Shard. The efficiency ratio of these businesses that they have relative to a company where its head office is in Shirebrook, and where the sort of, well, Mike Ashley owns 70% of the company and he was CEO. They just operate with a different mentality towards costs, and that's been improved recently because of automation. So they've got one of the most automated warehouses in the UK. I'll show you a slide on that. And then maybe the excellent capital allocation I'll come on to in the slide, and I'll tell you about how I think about the returns. But the last point to note is ex-CEO Mike Ashley only owned He has never taken a salary from the company. His wealth is in the paper of Frasers Group. And so I think he's highly aligned. His son-in-law now runs the company. Again, he doesn't take a salary, and he's incentivized in particular for the share price to be above £15. It's currently 8. So just on the next slide, something to point out about the sort of style of investing we've had. We started building up this holding in the second half of 2016. And what happened there was effectively they made a mistake on the hedging when Britain left the EU, sterling fell, they were unhedged, peers were hedged, and so they had a gross margin squeeze. And so our average in cost of Frasers is below £3 a share because we subsequently added to it in 2018. And it's compounded at broadly a rate of about close to 30% a year. But just to point out, the amount of noise you've had to tolerate, the number of drawdowns that you've suffered, the highs and lows, for that, coming back to the point about an IRR for a 25% return is quite significant. And this is why it really pays to know what you own. So going to the next slide, one thing that I think is underappreciated is the degree of change in Frasers Group. Sports Direct is just not the company it was 10 years ago. It's changed significantly. You can see on the left-hand side, it was just a pile 'em high, sell 'em cheap. On the right, it is now effectively an emporium to showcase the strength of its brands whilst retaining its value credentials. And why that's important is it's really transformed its relationship with key brand partners. On the next slide, so I've been to Shirebrook quite a few times since I started holding this investment. Firstly, the scale of it is incredible. It's 42 football pitches. Secondly, you can think about it, but the average retailer can't invest £250 million in automation. And the company said in its December results that it expects to deliver over £250 million of working capital benefits. And I expect that there will also be a cost saving from effectively labor reduction in the workforce. And if you go to the next slide, something that I think is really underappreciated with Frasers, which differentiates it from most companies I'd say I look at in the UK, is its attitude towards reinvestment. So what you effectively have is a really cash flow generative core business in retailing. Retailing is hard, and Frasers do well through their sort of mentality approach and their structural benefits, which they're constantly investing in. But what's extraordinary about the company is what it does with the cash that it generates. So it's got a growing stream of cash flow, and you can see here it's nearly spent 40% of its capital repurchasing its own shares. So its share price, so its share count's down, close to 25%. But it's also invested nearly 600 million in new stores. It's invested nearly £500 million in property. It's got close to £1 billion of freehold property on the balance sheet. And obviously, you would have probably read in the press recently, what they also are constantly doing is looking at businesses where they see value largely because of underperformance in some way or the other. And so you can see that they're a shareholder in Boohoo, in ASOS, and these are all actually quite small bets relative to the overall value of Frasers. But what it is they see a way to either improve the operations through a different management approach or through effectively sharing economies scaled. Just to tell you how I think about the returns here, and I thought it'd probably be better not to put this in a slide, is if you look at Frasers today, it should make over £1 of earnings. I think consensus is over £1, and so it's an £8 stock with £1 billion of freehold property and close to £2 billion of inventory on the balance sheet and £500 million of net debt. So the balance sheet's actually very strong, but let's ignore that. In simple terms, I think earnings compound at about 10% a year. And that's a combination of some gentle margin expansion and a top line growing 3 to 4% with a luxury business that is currently today materially under earning. And if you look at that, you would effectively come up with a scenario where the share count is falling by about 3% a year. The earnings are growing at about 10%. So you'd be compounding at a rate of 13, 14% a year. But in my opinion, 8 times earnings is a very low valuation for the business and its growth prospects. I can't touch on all of them because of time, which means that as an example, over a 5-year basis, if you were to price it to go from 8 times earnings to 12, you'd be compounding in the mid-20s over the next 5 years, which is what we've compounded at since the time that we've owned this investment. And just as an indication, that equation wouldn't even get you to the level at which the management team's share incentive scheme would kick in. So I hope that just brings to life, why do we have such a large holding? It's because we believe in the company, we have conviction in it, we think the returns are compelling, we think we understand the risks. As we've said, we run our winners. This was less than a 5% holding at cost. And I hope that just gives you an insight into the sort of approach we take across other holdings in the trust.
Great. Thank you very much, Kartik. It's quite comprehensive. I think you've answered quite a lot of the questions that have been going along. How do you use gearing within the portfolio?
Today, rightly or wrongly, because do you mean mechanically? So first thing is
borrowing, just yeah.
So we have a hard cap 25%. We're never really above 13. I look at what the portfolio weighted IRR is, and in my opinion, evidently, if we increase that by 10% less the cost of debt 5, I think it's an accretive thing to do today. And so we've been running with about 10 to 13% gearing since the pandemic. And I would clearly reduce that if, say the cost of debt went up, or if the prospective returns in the portfolio fell. So right now, I don't anticipate much change in our gearing, but I hope it's effectively a tailwind to our portfolio returns.
Okay, thank you. Now this slide is interesting. The dividend here. There's a question about this too. So, how are you thinking? How do you grow the dividend ahead of inflation?
So just to highlight, so the dividend yield's actually pretty low, and if you look at so if you come back to the portfolio slide, we do have quite, our bank holdings will pay us 8% this year. So growing the dividend from the level at which it is not that hard because it's covered by cash, and we have ample reserves if, for example, we were to allocate away from dividend paying companies.
Okay, fair enough. In terms of the international holdings, so what's can you just remind me again? So what's the kind of limit on that? And is it always just for things that you couldn't get in the UK stock market?
So the limit to be in the UK all companies sector on an IA basis is about 30% of NAV. 30% of the portfolio. And I think today we're at about 28, and we've been in the region of 22 to 30. Quite a lot of the time, the variation there is based on the performance of the overseas holdings relative to the UK holdings, rather than an active increase or decrease. Although we did increase that segment in the second half of last year because INA was a new holding, and we increased our holding in Google in the fourth quarter.
Just thinking about the banks for a minute. Obviously, we've got the NatWest share sale coming, which I suppose is sort of like an overhang. Are you worried about that, or do you think that that's just something that once it goes out the way, the stock will re-rate? And then also, what are you thinking about what's going to happen to credit losses?
On the NatWest share sale, you could make both arguments. You could say it's an overhang, and you could question whether the incentive of the management team might be to effectively have a more modest share price, which is a better deal for retail investors, right? So those would be negatives as a current investor. On the other hand, you could say that a removal of the government stake and making it fully privatized would improve the value of NatWest. So I could see it both ways, and I don't frankly know which way it lands. Net, I think it's probably, I'd rather it not be a consideration, but it is. On a medium-term basis, I think it's definitely better to have it in full private ownership. Credit losses, you mean credit losses in general relative to macro?
Yeah.
Sort of, yeah, I just don't. I think that's kind of there've been various panics about that over the last few years. I remember in September of 2020, Lloyd's was 25p, and all the concern was around credit losses. The reality is just that the credit books have just materially improved in their quality over the last decade. And there have been the pandemic only made that better because basically housing, which is their greatest credit risk, improved in value. And cash balances are very high because the savings rate's been elevated since the pandemic. So really, for these two types of banks, I think the credit loss risk is really quite limited because of the nature of how they lend. CRE would be the area of potential concern. You can see that offices are clearly going through structural change, but that's a reasonably small exposure for both banks.
Okay, thank you. There's quite a lot of stories in the press recently about sort of the death of the UK stock market and de-equitization and lots of foreign takeovers and that sort of thing. Is that something that you think is a real worry, or is this sort of overblown? And also, do you think the government should be doing something to encourage UK investors to invest more in UK companies?
Um, um, so the first question is what exactly, sorry, am I concerned that the UK stock market is actually dying?
It's shrinking, yeah, exactly. Your opportunity set is dwindling.
Yeah, look, I think that is a concern. That will come with an opportunity as well, right? Because I suspect some of the undervaluation you're seeing is a function of that. You know, I mean, I sit in Artemis and I can see the global funds exposure to the UK and what it is. And everyone knows that as well. And maybe it did come off a base of being too high. And look, I think some things are problematic. You look at Barrett Redrow on Wednesday at 8:10. Barrett had traded something like 10 million quid's worth of shares on a company that's worth 5 billion on a major piece of news. If that was America, it would have traded $100 million, £100 million.
Mm.
So, I think the liquidity point is material. You can see that companies that are relisting are performing well. I think, UK, US investors aren't dumb if they, and markets aren't dumb. They'll arbitrage it if they know it's possible, right? Like, it hasn't made Shell perform well, and it had its capital markets day on the New York Stock Exchange. So, yeah, I think it's a problem. But look, I think it's a mixture also of the bear market that UK stocks have been in.
And the second half of the question was, do you think the government should be trying to encourage UK investors to invest in UK stocks?
I think it probably would be helpful, right? Because you've got a whole range of combinations. Active management's been under pressure. That issue gets compounded in the short term. The US stocks that are really high, they're these US stocks that are incredible companies, but are also huge. And therefore the index is compelling because they're large weightings. MiFID II removed the scope for research of a lot of mid cap. And like I said, liquidity is just, is genuinely much lower in the UK than in the US. So you want to be careful because government, frankly, capital markets tend to sort themselves out, right? It might be brutal in the short term, and therefore we can create adverse incentives through government intervention. But I think something to encourage it would probably be helpful. And look, I think, I don't want to get too political about this, but I think some of the intervention from the FCA has probably been, actually, I can say that objectively, has been very negative for UK financial services companies, right?
Yeah, yeah,
You can see the
totally.
cost of
Yeah,
equity is extremely high.
yeah,
I made this point. Lloyds Bank is the largest bank in the UK. It trades on 0.7 times book. So the government should understand that if Lloyds Bank pays a dividend, it gives an investor a pound. If Lloyds Bank makes a loan, right, with its equity, it's destroying 30p. So that's just a really bad situation to be in when rates are not zero. And I think it's a function of this elevated equity risk premium.
yeah. Fair enough. We've covered an awful lot of ground. Just one question while we sort of finish up. And your discount is about sort of 15%, something like that. So are you using buybacks to try and tackle that?
Yeah, okay. So there's a long list. So we tried the discount is 15. And what I would point out is we have the potential for a tender opportunity in September, where 25% of the trust would be tendered.
Mhm.
And we have tried various different things to try and address the discount. So on our last tender, we proposed a scheme where we effectively were trying to do on-market buybacks instead, so that investors could have a chance to choose when they want to sell their shares. And effectively, we found that in the bear market that followed, it wasn't really possible for us to execute on that policy. So in my mind, I don't think buybacks are an appropriate thing for us because of the liquidity of the overall vehicle, right?
Yeah.
And so right now it is not something we're doing, but that is also partly of the fact that it is, there will be a tender opportunity.
Yeah,
So, in my opinion, investors should obviously hopefully see the value of their capital grow in line with the in line with the underlying. And so liquidity and discounts are not good things. But there are, as widely advertised, pretty significant challenges in trying to address that from a purist standpoint.
yeah. That's great. Thank you very much indeed, Kartik. We shall maybe get you back on in the year or so and see how it's all gone.
Great. Thanks for your time.
Thank you. Next week we'll be back with Hydrogen One. Obviously, that was the one that was postponed from a couple of weeks ago, and then we're going to say a full lineup all the way through into May. So 22nd of March, we're going to be putting more stuff out about this soon. But basically, we're having this quarterly panel discussion, and I've called it "Has the Tide Turned?" And it's really just looking at was the fall in bond yields from middle of October onwards, the start of a new kind of phase in the stock market, and just a shift into the way that the people are investing. So to talk about it with me, rather than me pontificating, we're going to have 3 fund managers. So we'll let you know more about that as we come. So thank you very much for tuning in today. Have a good week, and I will see you back next Friday.